Okay, today we're talking about liquidity pools. So, by the way, let's do an introduction and what is some wisdom. So, last week we talked about what is forex and introduction of forex, the brokers, what is lot size, what's margin, what's leverage, these kinds of stuff. We talked about this last week. So, if you don't know what's forex, I think you should go back to our old video and watch what is forex. So, but today we're talking about liquidity pools. So let's look at what is liquidity pools. Liquidity pools is the collection of buy or sells order at a specific what price level. Is the collection of buy or sells order at what a specific price level. So is the collection of buy and sells order at a what specific price level is known as what liquidity what pools. So common liquidity pools is what we call buy stop. There's what we call what buy stop orders, and what we call what sell stop orders. So the buy stop is above um the resistance level, while the sell stop is below the support level. So let's use a diagram now. Let's draw this a small diagram now. So let's draw another one. So look at the buy stop. The buy stop is here, while the sell stop is what somewhere here. So this is what we know as liquidity. Here is what we call sales order what liquidity pool. This one is what we call buy orders what liquidity what pool. This one is a buy stop liquidity pool. This one is also a buy stop liquidity pool. While this one is a sell stop liquidity pool. Why this one is also sell stop liquidity pool. Market can somehow go higher and then come down and sweep away the sell stop, then reverse and start trading up to the buy stop. Here will be your target, something like that. So this is how the market works. This so market makers engineer price to trigger what sell stop. So the makers mainly what engineers price to what to trigger what this the orders known as what stop loss what hunt. That's what we call stop loss hunts. The purpose of that stop loss hunt is to take away those what sell stop or buy stop. Let's imagine that the market is going like this high and then so stop loss hunt will come and take stop loss hunt will come and take away the let's say the sell stop that was here. So it will come down, take away the sell stop, then move on higher. So this is what the market maker normally does. So these are characteristics of the market makers. So let's move on to the chart. Let's see if we can move on to the chart. So this is Euro USD consolidation in a range. Breakouts happens, hit stops above the resistance and reverse. So look at this. He hits what stops above the resistance what and reverse. So let's look at this. Look at our buy stop here. Look at our sell stop here. So what did the market do? Does so the market came away. This is what they call a stop loss hunt. Some people place their stop loss here. So the market came what take away their stop loss and reverse. So do you understand? It went up what higher and reverse. This is what the market normally does. So it comes first before the market will buy. It must first what sell then buy. Before the market will sell, it will first what sell buy then what sell. So for it to go A, like let's say the market wants to go A now, the market will first go to B direction, then goes what A. But if the market wants to go to B direction, the market will first go to what A direction, which is up, then what goes to what B direction, which is what buy. This is what the market normally does. So before the market will sell, it must have to what buy. Before the market will buy, it have to sell. So the buying is what we call stop loss hunt. So it goes up to take away what those stop losses. those guys that play their stop loss above here. So now imagine in this market you're in a buy. Just let's say you're in a sell program in this market. So you sold here, like you sold here when the market, if this, okay, this is one of our time frame somehow. So you sold. So the market what did what they call manipulation, accumulation, and then distribution. It took it out because this um manipulation took your stop loss. Your stop, let's say that your stop loss is somewhere here. Let's say the stop loss is somewhere here. So the market has already taken you out. Then it bought small, then went down lower. This is what the market normally does. So, but this is a bullish trend. So let's use a bullish example. So now the market wants to buy. So what did the market do? The market came down and took away this sell stop. Look at their sell stop. The market came down, took away their sell stop, reverse. So this is head and shoulder. This market just created a type. They call it what? Bullish breaker or head and shoulder, something like that. So it created what? Head and shoulder. Look at the shoulder here. Look at the shoulder here, and look at the head. This is what the market did. So it came away. It came what? Took away their sell stop. They call it what? Sell stop what? Hunt. It took away their sell stop. Then those people that entered immediately, it came away and nearly took away their stop loss. Because if this thing was in GM, GPP USD, it have taken away the stop loss. It took away the stop loss in GPD USD. They call that movement ASMT divergence. But later we'll talk about this in this class. So it came away. It came and took away what? Their sell stop. Then reverse. So immediately the market reversed. It gave them an entry here. Look at what it gave them, an entry here. Small entry. So this is the fair value gap. Then entered and move away. And this is also a Venom model. So sell a quick sell candle and a quick bullish candle, and a space between them. The market came just enter this Venom. Look at it here. Enter this Venom, then push the price what higher. So this place can be your first target. This place can be your second target, and this place can be your last target. You understand? So this is how the market does. So the market also, this move self, you can say it did OTP. Look at the OTP entry. So the market came and entered this OTP. Like if you put your Fibonacci from here to here, if you put your Fib from here to here, the market this is like OTP. So it entered there and move up. It entered this breaker block itself. Look at this breaker block. This one. The last bearish, the last bullish candle before the bearish movement. This is it. Now this is a bullish breaker block. So the last bullish candle before the bearish, then the moving up. So look at it now. The last bullish candle before the bearish candle. Look at the breaker block here. This one. So the market entered the breaker block. Let's see. Look at it, where the market enter. Sorry, the breaker block here. So the market what enter the breaker block, then move up what higher. Even if you have your stop loss here, the market didn't even touch the stop loss. This is what the market what normally does. It came, take away the stop loss, and then move the opposite direction. So this is what you must have in mind, that market, if the market wants to buy, it must sell. What's the purpose of the selling? To taking away what stop loss. Then after when they are done taking away the retailers stop loss, then they will go to the main direction they wanted to go, which is what buy. So you must get it and get it well. So thank you, be safe. Subscribe to my YouTube channel. By next week we'll be dealing on so many concepts. Have a nice day.